talking today about Comerica and Fifth Third, who just announced their deal today. And there's all kinds of crazy stuff that I'm seeing on the internet as relates to a bunch of stuff. But your girl's going to explain it to you, basically, is what's going to happen here. A couple of things. Past performance is not indicative of future returns. I will actually have a baby position on this. Essentially, the options are doing some crazy things, and I'm testing out whether or not my theory and hypothesis is right. I'm going to explain to you why the options are doing crazy things, namely because we've had 4 years of the Biden administration, and the only banking deals that got done very quickly overnight. And I think people are a little bit confused right now as to the timing of when this deal closes. So you really shouldn't, on those October expiries, have any kind of you really shouldn't have any kind of premium left. But for some reason right now, those October 17s are trading with premium over the deal price. So let's get into what's going on. I do have some put spreads there. I'm going to give it I think that this is going to close like a normal deal. The only reason that you would have call spreads right now or calls over the deal price is because you think it's going to actually close similar to not a normal deal, essentially like a distressed banking deal. I don't know why you'd think that, but we're going to go through it. So past performance, not indicative of future turns. I'm not technically short this thing, okay, but I do actually have put spreads on over the deal price. Let's talk about it. Okay, so I'm going to share my screen. Boy, they have changed this up. Okay, and this is what was the announcement today. The announcement was Fifth Third entered into an agreement for $10.9 billion, and they are going to be buying at $82.88 per share. And right now, if you look at where it's trading, you're going to see Comerica trading at $80 and change. Okay, so very tight to the deal. And I'm just going to tell you now, that's crazy. And the reason it's crazy is because typically you're going to have a spread to the deal that lasts for some period of time. And this is trading without a spread to the deal. Okay. And that usually only happens if the deal is going to close right away. Now, the thing that is kind of a question mark for me is it going to trade like historically the way that banking deals traded, or is it going to trade in some fast track way through the banking regulators? And since Comerica is not distressed, I think it trades like the normal way. And so I'm anticipating that my put spreads expire worthless. Okay, so I'm short the put spreads essentially. Okay, above the deal price. So let's actually go through what's going on with Comerica and why they would want to do this deal, why it's strategic, etc. Of the large cap banks, Comerica is unambiguously the weakest of the banks. And it's the weakest of the banks because, quite frankly, they came into 2020, even before all the craziness with Silicon Valley Bank, they came into 2020 with more commercial real estate exposure. And that put them in a rough spot going into a massive rate increase, which then further exacerbated the existing workout that they were doing on their commercial real estate lending business. Okay. Now, for the most part, they've already taken all the write-offs that you need to take to make that business work. But, it's always really hard to know how to think about things. And when we look at this, what we can see is that you've got revenue down 4%, EPS down 5%, and deposits, most importantly, down 3%. Okay. The other metrics that matter, though, is the return on assets is 3%. Average common shareholder equity is down significantly on the quarter. Okay. But it's up from the first quarter. And so a lot of people, when they're focusing on Comerica, they're going to probably look at those numbers. They never looked at Comerica and not realize that actually this is an improved quarter versus the previous period. Nonetheless, Comerica strategically is in a funky spot if you've got a declining rate environment, because what's really hurting them is the fact that they cannot extend balance sheet given this particular set of circumstances. Okay, so then let's go to the second part of this, which is what is Fifth Third's financials from the quarter. You had revenue up 8%. Okay, so they did actually do they were one of few banks that actually grew the loan book. And you have EPS up 7%. So they had a good quarter. But look at the deposits. The deposits are down 2.4%. And here's where a lot of younger financial commentators don't understand what's going on in the banking system right now. Okay. Most of the big banks are not offering interest rates in line with anything close to what the risk-free rate of return is. Okay. So their borrowing cost, their actual funding cost is significantly lower than what the overnight rate is showing. And the exception to this is a stock that I talk about all the time, SoFi, who is actually taking advantage of the fact that their whole business model is totally different to offer a higher interest rate and therefore take market share. Okay. But let me show you what the interest rate looks like in contrast to something like a SoFi on the deposit book, so you can see what I mean by that. Okay, this is Comerica's funding cost. And what you do is you'll look at this section right here, which I will try to increase in size so you can see it better. Give me a second. Okay. And if you look at this, what you'll see is that checking is 2.77% as a blended rate. And if you scroll all the way down, you'll see that their blended rate of interest-bearing stuff, okay, down here is going to be 3.5 relative to their interest earned is 1.55. And as a result, you get a NIM, a net interest income spread of, you get a NIM of 3.16% and an interest rate to spread of 1.96%. So this is why I'm saying that you didn't really have any kind of meaningful problem with Comerica. Okay, but what you did have was a bunch of locked up capital. That's why you have 1.96 on interest income rate spread situation. Okay, now this though is 2.77%. That's what they're given in the way of deposits. This is Fifth Third, and what you'll see here is they're offering a lower rate, an even lower rate on deposits, and their NIM is really high. And the interest rate spread is much higher. Okay, so dollar for dollar, Fifth Third is actually making more than Comerica. That is what is meant by this is an accretive transaction, because when Fifth Third brings in Comerica, it's not just that they will reduce branches in the markets for which they have some sort of combination, because they both have a presence there, and that would be this. Okay, so I went ahead and ran this off for folks so they didn't have to look up what is the geographic footprint of these two places. Okay, Comerica is in those Sunbelt states. So is Fifth Third, by the way. Oh my goodness, I can clean this up. Look, I'm one girl trying to do this. Okay, but Fifth Third does have Southeast exposure, so they're all over Florida, in the Midwest. But so you do have some geographic footprint together in the Sunbelt states, specifically Florida, and sometimes, both of them actually are in that Carolinas area as well, but it's just not a bigger area for Fifth Third per se. So yes, you'll have a reduction in branches in some cases, but specifically Florida. But the bigger accretion is that difference in the spreads that I showed you, namely that these guys have this funding cost, which is much higher than the other folks, than the funding cost for Fifth Third, which is significantly lower. You got a higher NIM as a result with Fifth Third at 3.12%, and so on and so forth. Also, I would mention that buying banks is always the fastest way to grow your deposit base. It's the fastest way to grow your book value for any bank. This is what I harp on all the time with SoFi. And so I always find it interesting that I get so much pushback, because you literally are just buying the deposits. And because so many of these guys are offering a sub 3% rate, you would immediately, by virtue of bringing those banks in, create book value. You would immediately create net interest income that's really beautiful. Okay, so that is the main thing about this deal that I would mention. Now, the final thing that I would mention is I really want to show you exactly the spread on the book value, which is why the options on this, if they have any kind of duration on them, if this deal takes what I think it takes, if it follows more of a classic pattern, which would be something like, you know, 9 months to close. Okay. Like maybe because it's a bank, the regulators are a little bit of a different animals and there's a desire to just go ahead and let people combine. If we get like a really positive environment, maybe like 3 to 6 months. I mean, I think that's aggressive personally, but if it does more like that, then those later options are a cheap way to get Fifth Third Bank. And let's take a look at why that's relevant. Okay. That's relevant because when we look at the book values, okay, so it's always going to be book value. I'm not sure why suddenly my phone's going off. Okay. You're always going to look at book value, and you'll see that the book value of Comerica is 1.3 times book, and Fifth Third is 1.5 times book, 5.4. Why do we look at book value? Because book value is just the total liability assets minus total liabilities. And then if it's tangible, this is not tangible book value, but if it's tangible book value, then you modify for the intangibles. Okay, cool. But what's that mean for a bank? What you're basically saying is it's the stuff that's left over after all the financing and crazy stuff that's going on. It's the actual base capital that they have to either return to shareholders or otherwise do really exciting things into a declining rate environment. And a lot of folks are like, well, 1.5 book is a pretty aggressive. No, honey, it is not. Okay, let me tell you, when I first started in the business, some of these book values were at 5 times. We don't do that anymore because there's no way to lever up given the post 2008 period. But still, at 1.5 times, you'll see some banks as high as like 2-3 times book value. It's not a thing. Okay, it's not like a crazy thing at all for that to happen. Okay, so then, especially given that both of these guys have not been massively growing the loan book. To a lesser extent, Fifth Third did, in fact, one of the few banks that grew in this last quarter. But Comerica has had so much held to maturity because of that mortgage book, that commercial mortgage book. They haven't been growing loans, okay? Plus, they're a little worried about the deposits anyways. So they've been doing it by giving you peanuts for your deposits, and then enjoying the lavish interest rate that our beautiful Fed has been giving us. Okay. So if you then get a declining rate environment, these guys don't have to do very much to change whatever. You're going to see baby little bit of NIM compression. And by the way, anything over 2.5% is pretty good if we're honest. Okay. So both of them are well above that. So even if you get a little bit of NIM compression, if you have the rate decline, you get mark to market improvement, and you get a massive unlocking of capital. So that's how book values move from 1.5 to something that's not 1.5, or alternatively, stay right at 1.5, but then just show equity appreciation. Basically, if that was confusing at all, let me know. But what I'm saying is that the environment is going their way, so there's no reason to be anything but positive about this deal happening. But what I would say is that the timing is a little bit of a funky thing. All right, let's see if there's any questions. I'll always do questions. It's been a while since I've done this, so there's not a whole lot of you on here. May, it's been a while. It's been so long. Wes, it's great to see you. Thank you for checking in with my account and supporting my attempt to try to stay monetized on YouTube. It's a little bit rough because a lot of the settings are very different on the streaming software that I use. And there's not really any more comments or questions. So, join me for the next one. I'll be doing a lot of these and to try to keep my monetization alive on YouTube. Take care.